And welcome, everybody. My name is Bruce Alexander. I'm President and CEO of Vectra Bank, Colorado, and we are just so delighted to have you all here today. It must say something about the state of the world and our economy that we sold this event out 2 weeks ago. Every seat in the House is taken, and we've got 600 to 700 people across the state joining in via video. So I guess everybody wants to hear what you all have to say today, so that's pretty exciting. We're very pleased about it. And I want to make sure that I extend a special welcome to all of our folks across the state. We appreciate the opportunity to share our event with you and all of you here, and hope that you really find today's information insightful. Looking back over the past 30 years history of this event, I'd like to say we've seen it all. Over the years, we've discussed and dissected multiple recessions, bull markets, bear markets, regulatory and legislative issues, politics, pandemics, changes to the economy in both fruitful and challenging times. On the screen this morning, if we could put this slide up, I think it's really interesting to see what we've talked about in our management meetings with our team. If we'll go to the next slide, I think you'll find this interesting. This is maybe a little hard to read, but we met with our management team and said, what's happened to us as a country, as a community over the last couple of years? And if you go back to March of 2020 when COVID came, and it started this whole array of issues that we've had to address. It brought in work from home. It brought in the infusion of massive amounts of liquidity into the economy and the PPP loans. The Fed started cutting interest rates so that there would be flexibility in the economy. Then the George Floyd murder happened, and we had racial unrest across the country. We started to see inflationary pressures because of all of this liquidity in the marketplace. We then saw supply chain disruptions that impacted so many of our businesses and real estate economy across the state. Then what happened is we started to see a labor force tightening, and so many of our customers told us that they couldn't find people, much less pay for people. So all of these challenges back to back to back. And as inflation then started to rise across this spectrum, the Fed had to step in again and to begin to address slowing that inflation by raising rates. We saw the Great Resignation with so many people deciding they wanted to work from home, they didn't want to come back to work. That put more pressure on the marketplace. And just when we thought we'd seen it all, then we saw the war in Ukraine come to bear and all the challenges that came with that. And then in the spring of last year, the liquidity crisis and 5 banks failing because of the pressures of interest rates. It's hard to believe we got through all that stuff, isn't it? But I think what it says is that it's really important now more than ever to pause and reflect on where we are, what's ahead, and what are the next steps that we should be. So today we are joined by 2 accomplished economists, one with a direct background at the Kansas City Federal Reserve, and another with the insight and experience of government office and one of our state's top universities. From our speakers today, you will learn where we are in the current economic cycle. You will hear about the trends and the core drivers of our economy and what to watch for in the future. As you listen to our speakers today, I encourage you to identify the lessons you can incorporate into your own world, into your business or your organization, and look for insights that will help you plan for the year ahead. We've left some time at the end of our event to give you access to the speakers. At any time, you can submit your questions using the QR code printed on your centerpieces with those handsome photos of our speakers. To our webcast participants, you can submit your question right on the webcast homepage. So lots of opportunities. We've already gotten a lot of great questions that have come in today. So today's first speaker is Henry Sobanet. Henry is the Chief Financial Officer and Senior Vice Chancellor for Administration and Government Relations within the Colorado State University system. He's a Colorado native, educated in Denver at Regis Jesuit High School, and holds a bachelor's degree and master's degree from the University of Colorado. Henry, I think, is a little conflicted. He doesn't know whether to be a buff or a ram, but maybe you can speak to that. Governor Ritter, I think you have that same kind of challenge. So anyway, Henry's professional career bridges from both a public and private sector with stops along the way at the Colorado Legislative Council and the Governor's Office of State Planning. From 2007 to 2011, Henry was the president of Colorado Strategies, LLC, a firm that specializes in economics, public affairs, and strategic management. He's one of the good guys in Colorado. Please welcome Henry Sobanet.
Well, thank you, Bruce, and thank you to the sound guy. I have requested Led Zeppelin, but that's close enough. And then those awkward things on your table with our pictures, that was obviously pictures taken before you heard about my career, and this is the after photo right here that you have. So it's a pleasure to be here, and Bruce gave a great setup about what we're going to talk today. So when I do remarks like this, I don't do them very often anymore, and so I end up reteaching myself a little bit about how do we explain what's happening, how do we digest what's happening, and what's the best platform to look forward from. So this might be a little bit weird because it's so dissonant to hear a cheerful economist, but I want to start out with an optimistic slide, which is to remember that the economy is usually expanding. And so what you're looking at is from right after World War II, inflation-adjusted gross domestic product per person in America since 1947. And the trend line is fairly unambiguous. You don't need a degree in economics to notice that. And after the Great Recession and the pandemic, you can see we've resumed that upward trajectory. So the shaded lines that you see there are the times we've had recessions. So it's not always up. There are periods of drops, but the past from which we're looking forward from is pretty clear, and that's, I think, a source of optimism. Now, your mileage may vary, and this issue has been accelerating the last 40 or 50 years, income inequality, who earns money and who pays taxes. And so what you see here is the share of income earned by the top 10% of earners. And so in 1970, for this time period, it was at the low point, around the top 10% earned about 30% of income. And now it's 49% in Colorado, 53% for the country. This has implications for tax policy. This has implications for your business planning. Some of you may be competing all for the same customers who have the disposable income you'd like them to spend at your business. And when somebody says, why do they keep cutting taxes on the rich? It's because a disproportionate share of income is falling on a smaller number of people. So I was lucky to do a speech like this last year, and it was interesting to try to compare and contrast what were we talking about a year ago compared to now, and there's a lot of similar issues, maybe different percentage emphasis, but we've been worried about inflation. Was there going to be a recession? What's happening with the Federal Reserve? But a lot of what's happening with economics right now is social commentary is spilling into the commentary about economics, and so the feelings about the moment, the anxieties, the political fights, they're spilling into how people are discerning the economic activity that's happening. And so I'll try today to give you enough perspective, enough long view that helps maybe give you some touch points for you to reframe your perspective about looking ahead. But really right now, Federal Reserve policy, we're going to hear from Nick in a minute. The election is dominating, I think, a lot of coffee table conversations, kitchen table conversations, boardrooms. Housing affordability remains a major issue. We'll talk a little bit about property taxes in a second and other issues like that in Colorado. But we also see slowly returning consumer sentiment. The end of 2023 saw a big jump in the Michigan Consumer Sentiment Survey. The San Francisco Fed has a metric where they track headlines, and the positive economic news that we've been experiencing lately has been showing up in their index. Their index of headline sentiment has been increasing. But we are at war, either by proxy or directly. Ukraine war, the war in the Middle East now, and then I have China here with an asterisk. So it's between the cybersecurity issues, the trade issues. All of this is kind of in the background. So against a backdrop of growth that has been amazing. The American machine is truly remarkable. The extent to which we are extended into other things besides producing goods and services is an issue this year and probably for a couple more years. So why, if in real GDP is growing, employment is strong, unemployment has dropped, why is there a vibe of glum out there? And so I think this chart has a little bit to do with it. So on the right-hand side is the consumer price index, the level of it. And you can see the acceleration in the level of consumer prices post-pandemic. Remarkable. Not the stability that we were used to for many years, and not the stability that you'll hear about Nick talk about the goals that the Federal Reserve has that we're used to. People feel like their dollar is not going as far as it used to. Food, energy, housing, whatever the household basket for that household, the dollar isn't going as far. And then housing costs, as we've had higher interest rates to slow down inflation, has very much changed the equation for buying a home. And you end up having a lot of people with that 3% mortgage saying, you know, it's pretty good. I think I'm going to keep a pat hand here for a while. So turnover in housing has changed, and then the ability to buy and enter the housing market is different. I think this chart is a big percentage of against a top-line, headline growing economy. Why do people not feel as good? I think another reason is that business planners, boards of directors, bankers, they can look at this chart too. And I don't think you need a degree in economics to see the basic dynamic here. And what I've done with the arrows is every time the Federal Reserve, or most times, the Federal Reserve has raised interest rates, we get one of those shaded areas, which is a recession. And you can see the pattern is pretty consistent going way back. And so we are at the far right of this chart right now. And so the three question marks are, the economic statistics are still looking pretty good. There's no statistic looking right now that it would approach defining a recession, but this federal funds rate is where it is, and it will be there for an indeterminate period of time. And so what happens after that? Will this pattern repeat itself? I think that's been partly why there's been anxiety about we might be in for a recession. So the question ahead is, can we buck this trend? Bruce mentioned the Great Resignation, and it wasn't just kind of like a meme thing. It happened. This is the quit rate. So this is the rate at which people are voluntarily quitting their jobs. And if you really want to geek out, this is kind of cool because you can see when people feel more confident about the economy, they're more confident in just taking a plunge and switching jobs. And so the Great Resignation did happen. And when you do a little bit of digging as to what happened, it was a little bit about work from home, but there was some really strong research that showed it was how people felt at work. So I know all the bad managers didn't get to come to the luncheon today. And they're eating their sandwich at their desk. But the workplace culture was a big driver as the economy recovered from the pandemic of people saying, I'm going to look for something else. But now, storm clouds, expensive goods and services, expensive housing, it has obviously changed a little bit of people's behaviors, unless all the managers got wise and got better. But I don't think that's exactly what happened. So if this ends up being a what's in quotations a soft landing, I would expect this number to maybe kick up a little bit. We've seen some weakness with some consumers, delinquencies on car payments and things like this. But taking the long view of consumer debt as a share of disposable personal income, it seems, I don't want to say modest, but it doesn't seem alarming. People saved a lot of money during the pandemic because there wasn't much to do except buy Rolex watches and cryptocurrency. And so, but for the most part, people saved more money. But now they're spending and they're buying back to almost regular levels. It's hard to tell from this chart because it bounces around a lot. So it's unclear whether this is a source of concern or not. And it's hard to do a talk about the economy without talking about the federal deficit, because I don't think as a group, as a society, I don't think we understand how it works totally, which is totally a confidence building thing to hear me say. And so I decided it's totally fine with an asterisk, of course. And the asterisk means different things to different people. Can we sustain it? What happens if interest rates stay high? What if the federal government doesn't align expenditures and revenues? What if people's confidence in American debt falters? But the share of GDP federal debt is now in the high 90s. It went over 100% as we managed the pandemic. It's coming down a little bit, but that big growth after the Great Recession, that was stimulating the economy to come back. That was the surge in Afghanistan, if you remember that, and also the expansion of healthcare programs at the federal government. So all of this is kind of in the backdrop because at this high level of interest rates, this budget line item is bigger than it was before. It's almost as big as the federal defense budget now, interest as a share of the federal budget. So there's work to do there, and the path forward is a little bit unclear. Okay, so a little bit more of the long view to maybe help understand where we are now. So this is 30-year look, 1990 to 2020, Colorado employment and population versus the United States. Most of this gap happened in the first 20 years of this slide. The last 10 years has been about even, for the most part, Colorado versus the United States. What we had that drove this may not still be here going forward. We had a relatively lower cost of housing. We had a little bit more availability of just the resources to get work done. Water is continually a constraining issue for our state. We continue to import a lot of in-migrants to fuel our high-wage jobs. That might be slowing down a little bit because of affordability. So that virtuous circle that allowed this disparity to manifest might not still be here. So we'll circle back to this in the next few slides. So let's reorient here. So what's happening now is we are at the tail end of massive government stimulus to get us through the pandemic. So there's still 2 or 3 more years of the schedule that those monies were supposed to be spent on. Everybody, all the economic world is watching the Federal Reserve. About a month ago, people were thinking there might be 3 rate cuts this year. Nick won't tell you what they're going to be. He's not allowed to. But now, this week, it's like, oh boy, maybe inflation is still not coming down. Maybe there won't be 3. So their job is to keep us guessing, and that's back in the background. The federal government has adopted some interesting infrastructure legislation the last few years, the Jobs Act, the Inflation Reduction Act, the CHIPS Act. This will change a little bit of the baseline going forward. There's a lot of powerful incentives in those laws that they will be part of the economic forecast picture going forward. But at play most of the time is the 2 big cohorts in our demographics moving through the economy. The baby boomers will start to turn 80 starting in 2026. And so all of those issues with a big cohort of aging population, transportation, healthcare spending, housing policy, all of that's happening for that big cohort. The other big cohort is the millennials. And they're no longer the charming people at the bar with long beards and glasses. They are grandparents now. And they're doing all the things that people in their late 30s and early 40s do, and that includes building up households, saving for retirement, raising their kids, looking at college and all that. So as you're looking at your customers, those 2 driving forces are the biggest demographic driving forces happening right now. They're slow moving, and the daily headlines are not going to affect the dominant influence of that. The other thing is that for the last 50 years, the national economy has shifted away from goods producing to services producing. So this isn't a value judgment, it's just other places produce some of the stuff that we use, and we buy and sell more and more time from each other. If you're buying time from people, there's kind of a natural barrier there to the amount of time they're willing to work for you. So on its face, on the average, that will mean probably a little bit of a slower trajectory. And then again, for Colorado, it feels like some of our advantages relative to 30 years ago have changed. Housing affordability, business climate. There's some data points that just make it seem like we don't still have the same advantages as before. So we've had a lot of debate in Colorado on property taxes, and I know you're eating lunch, so please bear with me and don't get drowsy. I will make this as quick and painless as possible. So property values went up a lot the last cycle. And because we repealed a law called the Gallagher Amendment, your property tax bill probably went up more than it used to, depending where you live. So what we repealed was this ratio of tax burden of businesses versus residential. The old law biased the tax burden on businesses at about 55% of value, and residents picked up the rest. As you can see at the little pie chart at the bottom, there was a substantial growth in residential value relative to non-residential value. So how do you keep that ratio the same? And you manage it through something called the assessment rate. So it's the percentage of a property subject to property tax. Are you with me? Have I lost you? It's the share of your house subject to the mill levy is the assessment rate. So to manage it, the legislature would reduce the assessment rate to keep that ratio going. When Gallagher passed, 21% of your house was subject to property tax, and now it's in the high sixes, and it will default back to a little bit over 7 under current law. So that dynamic has been in the background, but since the residential assessment rate doesn't drop by formula anymore, tax bills on the average are higher than people have experienced in the past. The reason it's so important to talk about property taxes is that there's a symbiotic relationship between local property taxes and the state income and sales taxes that fund school finance. If you're thinking about taxes and you're thinking about Colorado tax policy, you start with school finance. It's about half of the property taxes you pay, depending where you live, and it's 40% of the state taxes you pay to the general fund. So what isn't generated by local share, the state tops off and fills up to get the formula that's in law for each school to have. Some school districts have extra property taxes called override mill levies that top off that and don't count against what they get for the state. But as you can see here, the agreement of who pays for what and what percentage has drastically shifted over the years. So when Gallagher passed, most of the property taxes most of the budget for school funding came from local share. But with Gallagher's passage and then a law in 2000 called Amendment 23, where the voters said we want a formulaic increase in school finance, even if you don't have the money, dear state of Colorado. That's how you run your businesses, right? Yeah. So that caused the state share to increase while the local share was dropping. So it's kind of a two-shot swing for the golfers in the room, the wrong direction. So the extra burden to the state by the dropping assessment rate has crowded out healthcare, makes tuition higher, the ability of the state to supplement the transportation budget, et cetera, et cetera. So this dynamic is playing in the background. And as you can see now, the shares are mitigating and getting more equalized, but it's still a system that is not coordinated and needs some alignment. And so what's happening now, there's a commission established by the governor and the legislature to look at, okay, can we agree on a path forward that mitigates some of the increases that we've seen in a fair way, and can we adopt a policy that would be more sustainable and manageable going forward, given that we want police response times to be good. We like fire departments. We care about school finance and having an educated citizenry, but we also want lower taxes and we want to keep our business economy vibrant. So you can see all the competing functions that we're asking out of our property taxes here. And so the path forward is a little bit murky. There's some organizations filing a ballot issue that would be a very, very difficult chiropractic adjustment downward on property taxes, cause a lot of disruption in the state budget. So hopefully there's a better path forward. And I would argue, without the business community at the table to help manage, the civic conversation, I think the polarization that we have in America, which is spilling into Colorado, is going to make a less vibrant decision. So that's, sorry to jump in so aggressively with such shocking concepts, but your civic engagement might help this conversation going forward. So we have a forecast at Colorado State University that we sponsor with the Colorado Futures Center, produced by Dr. Phyllis Resnick. Many of you may know her. And these are the variables that go into this short-term forecast. It's a leading indicator forecast meant to forecast the first 6 months, and the positive and negatives that you see here are the correlations with these statistics. If she were here, she could explain it to you, but I'm giving it to you just as an accountability, and I'm still learning the model even a couple years into it. But even I can understand this chart, and this is what the look ahead looks like. It's obviously a little bit of a slowdown, but still a growing Colorado economy. The latest iteration came out just yesterday, and it's still right there at that 2% annualized growth rate. So a steady growth ahead, even with all the swirling that we've been talking about. We still have many, many tailwinds to be confident about, but not the growth rates we've been used to. And that's further buttressed by our friends at the Colorado Legislative Council. What I've done here is go back a few years and show their forecasts and how they have changed. It is not to critique them on how good their numbers were, because we all know how that feels. It's rather to show how the shift of the look ahead has changed from just a few years ago. So the red line is 2021. And you can see the slope of that line is a little bit sharper than the purple line, which is the latest forecast. So it's not as an aggressive look ahead that we're seeing from the forecasters at the Legislative Council. They are picking up on this slowdown too, but still growing. And in 2025, for the first time ever, this statistic, non-farm jobs, will exceed 3 million jobs in Colorado. I think that's noteworthy. Nick and I were talking, there's a massive data revision that might change the level of this, but I think the direction and the slope of the line is what I would ask you to take stock of. Okay, so a year ago, we were focused on housing and business policy at the state legislature. It's still the same thing a little bit this year. The housing conversation is going to get split up into a few different bills. There's a little more bipartisan activity, which is encouraging on that. Property tax policy is not settled, but it's very much part of the conversation. Federal Reserve policy, I won't step on any of Nick's comments coming up, but right now, the consensus forecast from a lot of economists is it's soft landing in quotations, because there might not be a landing. It didn't feel like we were flying that high. It's meaning landing, from the perspective of that really, really vigorous inflation that hurts everybody. Whatever your opinion is about climate change or the causes of climate change, I think it's inarguable that we are seeing climate adaptation to be more and more a business as usual conversation. It's either policy of what you can build, it's part of your insurance conversations now. So this is activity that's business as usual, adapting to our climate if we can't change the direction of how the climate is performing. I don't mean to be flippant about artificial intelligence, but it's really hard to make sense of. Are the computers going to take over and ruin everything? Are we just going to have it in the background and have it be an amazing new tool? I'm very concerned about garbage in, garbage out with these models. These can be very much manipulated to our disadvantage. So I think ultimately it's going to be the human pairing up with the robot that will make everything more optimal. That's typically how technology has worked when it disrupts the economy. And then again, our economic commentary is getting conflated and muddled with our political and social commentary. So I hope I gave you today some touch points that you can distill what's happening with the economy and separating out what's emotional or political as you try to determine the path forward for your company or your business. I'm grateful for your time and attention. I'm grateful for the invitation, and I'm excited to hear from Nick. So thank you.
Thank you.
So I always appreciate Henry's comments because he takes the component parts of the economy and ties it into the reality of politics and what goes on. And hopefully there's a lot of lessons in there for us as citizens about the topics that we need to engage in. And I know Henry would be happy to chat with you afterwards about that. My favorite slide in that presentation was the one about the Great Resignation and all the people that quit. So the message in there to all the employees from Vectra, where it said during that time, it said, take this job and great idea, boss. I thought that one was really great. So just remember that as you think about employment opportunities ahead, that connecting and enjoying where you are is probably a good thing in this economic cycle. So Henry, thank you so much. That was great. Our next speaker today is Nick Sly. Nick is the Vice President and Denver Branch Executive at the Federal Reserve Bank of Kansas City here in Denver. In this role, he serves as the regional economist, and representative in the state of Colorado, Wyoming, and northern New Mexico. So he really gets to see the economy throughout our area. Nick works closely with the board of directors of the Federal Reserve Bank of Kansas City and is responsible for briefing the bank's president on economic conditions throughout the region. Having personally served on the Federal Reserve Bank of Kansas City's board of directors here in Colorado, I can tell you from firsthand experience, this is no easy job, but Nick must skillfully interpret and balance information from so many different sources. And one of the things the Fed is really trying to do is reach out to people like us and learn about the realities of our own economy and our own businesses and the things that are sort of the street truth in the market. And so providing that kind of connection is really important to Nick and the Fed, and I certainly would add value to you all as well. Before joining the Federal Reserve in 2015, Nick was an associate professor of economics at the University of Oregon. He graduated from the University of Northern Iowa with a degree in mathematics and economics and earned his PhD in economics from Michigan State. He's really a delight to be around. He's so wise, and I already have a ton of questions relative to interest rates. So we'll see how much he can address with that without moving the stock market. So please welcome Nick Sly.
Good afternoon, everybody. I have the tendency to move. It also helps make sure that I can hear some questions or comments as they come up, because Bruce said it perfectly. One of the most important ways that the Federal Reserve does this thing called monetary policy is by not just doing the analysis, but asking the question, what did we miss? What aren't we hearing? What are some of the communities that we need to be hearing from that should be part of that economic dialogue? And so I'm really thankful to have the chance to be able to connect with such a wide array of folks that are in this room. Whether I've recognized some folks from commercial real estate, some contacts, and some folks that provided key input with regard to energy markets, not to mention the banking community. And it's great to be able to reconnect with you and report out a bit. Here's some things that I'm seeing, things that are influencing my thinking, for somehow maybe you could tell me where you might be seeing things differently, or maybe issues that I should have been thinking about that are weighing on your business's thinking. I really want to hear about those so that I can maybe incorporate them into our own analysis. So we've got a variety of folks in the room that help me do this. There's some alumni directors, some of our current boards of directors, my community development partner, Ariel Cisneros. There's a number of ways that we want to engage. And so I will get out a variety of pieces of information. Kudos to you all for 2 economist presentations and that much data in the middle of the afternoon. I'm impressed. I feel a sort of a kinship of this is what we love to do all day. So let's go ahead and get into it. Henry said it right. A lot of the focus of the last year, what was weighing on households' minds, clearly what was weighing on the Federal Open Market Committee's minds as they're making decisions, was the rapid rise in inflation and policies that were enacted to be able to curb some of those price pressures. I'm going to try to split my remarks in a couple of different ways. I want to do a look back over about the last 6 to 12 months, not because I want to do an accounting of what happened, but what happened 6 to 12 months ago may not be the same types of shocks, the same types of developments, the same types of market issues that are actually going to be impacting your decisions or your outcomes over the next 6 to 12 months. So it serves as a nice baseline when you're thinking about, are we at a turning point? Are we at an inflection point? Is what changed from the last 6 to 12 months versus what was actually happening going forward? And so one of those highlights over the last year, it was really gains in the supply side of the economy, and I'll dig into what that means, that actually supported overall economic growth. And in fact, you had interest rates going up by 500 basis points, a real tightening of financial conditions, and yet the economy still grew and inflation still came down. What I'm going to try to highlight is there's a series of these supply factors that really supported that disinflationary pattern that we saw. So when you get to where we are today, the question then becomes, well, are we going to see continued inflation? Are we going to close the gap of that last 1 percentage point, get back to 2% inflation? I want to be careful to say, I'm not going to look for the same types of shocks that occurred over the last year. Might maybe look for something different than these supply shocks that we saw over the last year. Okay? Inflation is certainly slowing, but where you're seeing some stickiness, why you might need to see something different, is that housing prices and labor services prices, those growth rates remain largely elevated. And I do want to differentiate what we're seeing in the data from what I'm hearing when I talk to folks like you in the room, getting those anecdotes about what is driving your decisions. What are you seeing that might be different than what we're seeing in the data? We're actually seeing that many of the businesses are reporting slower growth in their hiring plans, slower growth in their compensation plans, maybe a little bit less spending on consumers' parts that hasn't quite shown up in the data too much. And so that's actually looks like there is some indication that there's some cooling. So I hope that's some organizing principle for conversations today as we dive into the data. Okay? And before I get into it, just give the standard disclaimer. Everything that I'm going to present is thoughts of my own. They don't represent those of the Federal Reserve Bank of Kansas City, nor the Federal Reserve System. I'm happy to talk about developments in monetary policy, but leave fiscal policy discussions to those, your conversations that you have with your elected officials. I think that's all of it. There we go. All right. All right, let's get to work. All right, so what happened over the last year? So we saw that certainly unemployment remained very, very low, but it remained low broadly. You had unemployment across racial groups, across ethnicities, between men and women. Unemployment remained very, very low and fell quite quickly following the pandemic. That was despite the fact that the Federal Reserve raised interest rates by over 5 percentage points in the last year and a half. Economic growth towered over 3%, well above what we would think would be a historic norm. And so, as I was hinting at, the argument is that there were a number of supply-side factors that really pushed that forward. Okay? One of them was the increased availability of labor for the U.S. economy. Okay? Is you actually saw labor force participation rates pick up. It picked up really quickly here in Colorado, but the rest of the nation saw that sort of bump. So a larger fraction of individuals were actually willing and able to go to work. They were facing some of these constraints. Women came back to the labor force. Now women's labor force is at record levels. There are more women, college educated and not, that are back into the labor force. Black labor force participation is at record level or near record levels, okay, for both men and women. You've actually seen Hispanic labor force participation peak up. You're seeing broad engagement and entry into the labor force. And not only that, among the pool of workers in there was a resumption of immigration. So you actually had a larger pool of folks that were able to enter the labor force, despite the fact that we have an aging population. We're looking at looming retirements. So you had more workers available to work, more workers willing and able to actually come to the labor market, and that was able to support businesses, be able to support economic activity, and in fact, cool some of the wage pressures that was such an inflationary pressure over the last year and a half. So that's one of the supply factors that I've been focused on. Saw a great chart, Henry had it, is the quits rate is back to normal. So it was not only was it able to find workers, it was a little bit easier to keep them in the door. That was certainly true. But besides the worker side, when they got there, what we did see was an untangling, okay, or a clearing of the bottlenecks in supply chains globally, okay? It became, materials became more available, equipment became more available, technology, machinery became much more available. The delivery times on those really improved dramatically. So you actually saw a shortening of the delays in that amount of time out there, which meant that you had more workers willing and able to go to work. You had more workers actually applying for jobs. And then when they actually showed up and got there, okay, they had more materials, they had more equipment, they had more capital to do their jobs with. And that also was kicking the supply side of the economy up. It meant that businesses were facing a little bit lower costs in getting those materials in. They were getting more workers to use them at somewhat lower costs, and that was disinflationary. All this over the last 6 to 12 months. Okay. And finally, when I look back and think about the disinflationary supply side pressures that were out there, is productivity has surged. So not only did you get more workers into the door, you got them to stay in the seat, and you got them capital and material and equipments to use. They became much more adept at using them over the last year than we've seen in recent decades. Productivity has really soared. So those are 3 real supply-side kicks that were absolutely disinflationary. And it means that inflation has come down from 9% or 8%, depending on which measure you want to choose, down to 3 to 2%, clearing in on the target. And so it's getting closer and closer to the Fed's stated goal of 2%. But now I want to pivot and say, looking forward, the question is it likely that you're going to see another shock, another supply side kick? Is it likely that you're going to see even more workers when we're already at record levels of participation? Is it likely that you're going to see even more size of the labor force when we're entering the baby boomer generation, we're having more workers retire? Is it likely that we're going to see another more improvements in supply chains when we've already seen freight rates go up because of disruptions in the Middle East? Is it likely that we're going to see more improvements in supply chains when businesses are reorienting themselves away from just-in-time, very lean supply chains to things that they're regarded as being more resilient? Okay? And I do have questions about whether or not this level of productivity is really going to be resilient. Is it going to be persistent? We're going to see this type of productivity growth, what we haven't seen in decades, continue. And I have some concerns about that as well. One of the other factors I'm sure all of you felt this, during the Great Resignations, one of the key challenges was not just getting people in the door, but then you had to devote an awful lot of resources to getting them onboarded and training. It was a real drag on productivity. We've seen that reverse now, but it's not obvious that we're going to get an extra kick. Okay? So that is more pessimistic. I can hear it. I can hear that sounds so much more pessimistic than I meant it to be. But it just means we need to start looking for something different. Where's the disinflationary pressure going to come from? Where are you actually going to see the last 1 percentage point of getting inflation back down to 2%? And what additional factors would you have to need? It means pulling things down. Headline inflation, the overall number, is a little over 3%, depending on which way you measure, a little over 2%, depending on which way you measure it. Shelter inflation has been a little bit sticky. Anything with requires labor services has been a little bit sticky. So all the great folks in the room that have been helping us out, folks at restaurants or at hotels, the labor cost there has still been growing at an outsized rate. Where might you see some of those pressures abate? That's the question going forward about what might drive inflation the next few steps. And I hope that I understand why that guides my thinking. Okay? So are you seeing slowing in wage growth? We're starting to see some early signs that wage growth is slowing. It's elevated. It still remains elevated. It's okay that it's elevated if productivity stays high. It's fine to have wage growth be high if actually productivity is also high. That's a sustainable level of wage growth. But you're starting to see it is, in fact, coming down. And a development that I'm trying to understand is the difference between those blue and the green lines. Not in recent history have you ever seen this big of a switch, a big of a difference between hourly earnings and weekly earnings. And it's looking into that, it really says businesses are using overtime a little bit less. They're using fewer hours. They're not asking people to stay on board. They're starting to use more part-time work than they had been over the last couple of years. And so it really looks like something of a slowing in overall labor demand. Maybe that's an early sign that we've gotten away from relying on the supply pressures, now switching to, are the demand pressures slowing in a way that's actually going to sustainably move inflation back down to 2%? Some early signs of that in terms of wage compensation. Okay? Maybe a better way to do that is just to go and ask businesses, which we do. We run a number of surveys. We directly ask them, what are you planning to do with your hiring? Okay? So for 2022, we ask them at the end of 2022, looking ahead. So then the green bar is 2023. We asked them at the end of last year, and we were asking them about this year. What do you plan to do with your hiring? And more businesses told me they don't plan to change their hiring. They're trying to keep their headcounts about the same. Okay? Fewer businesses were doing the increase. But I will note, not that many businesses saying they plan to decrease their headcount yet. So it's slowing demand, not declining demand necessarily, slower demand growth. Okay? To me, this has been one of the most important ones, businesses have told us, and I'm calling this employers' New Year's resolution. They are resolved as of Jan 1, and they're holding it through spring break so far. They are resolved to change the way that they are compensating their employees. Meaning their wages used to be, or the wage growth, their raises used to be oriented around new hires. That was the Great Resignation. Wage growth was oriented around retention. I got to keep them inside the door. Okay? The wage growth was oriented, anybody and everybody, okay, that has that comes into our door, we're going to raise the wage profile for those individuals. That was the compensation strategy, to retain, attract workers. And what happened is around this year, and the resolution around January 1 is coming into 2024, businesses are telling us, actually, we're not raising wages, many of them is the right side of this, we're not necessarily raising wages for new hires. That's a new development. More businesses saying we're not targeting that. Even more businesses saying we're definitely not giving raises broadly. We're only giving them to certain skills, or we're only giving them to certain job types. We're only giving them to individuals that actually are taking on new responsibilities or are taking on new roles. So you're seeing that now the wage growth story, the wage growth strategy has been much more oriented around the workers that are actually being more productive and taking on those additional responsibilities. That is a fundamental shift in the compensation strategy, regardless of the level, just towards something that is more sustainable. So to me, this is an early indicator that, yeah, business demand has really shifted. Employers' demand for employees has really shifted in a way that could put some further cooling on that overall wage growth pressures. We're going to ask this again because this is something that I want to follow up on is, are we able to stick to that New Year's resolution? Because I think it's fundamentally different. It's hard to see in the data because there's something special about January 1 and the way that we think about our compensation strategies. It really is different when you move from one year to the next. Okay? Are we seeing slower labor demand? And you can see the recurrent theme. I'm trying to get away from these supply side factors and ask these questions. Are we seeing slowing demand from the business community? For sure. We have undoubtedly had very strong jobs reports. 350,000 jobs that were added in the economy in January. Something that I paid attention to, it didn't seem to get as much of the headlines as, at the same report, the December number was revised up 112,000. It was 100,000 more jobs in December that were added that most folks didn't necessarily see. So that's very healthy job growth. And in fact, November was revised up a couple tens of thousands as well. So as a nation, there was an awful lot of job gains. But then digging under the hood, actually roughly a tenth of those in the latest report, over almost 20% in the last 6 months, were jobs that were added not by the private sector, but were added by the public sector. This is federal and state and local government employment that was really being added. And Colorado has very much been a part of this in a very real way. Almost all of the job gains in the latest report were not private sector jobs being added. It wasn't businesses recruiting additional workers. It was the deployment of Infrastructure Act. It was deployment of CARES Act, ARPA, some of the dollars that went out. It was federal stimulus dollars that really boosted the overall level of job gains here. Colorado is actually in a position now that it hasn't been mostly for a couple of decades. Henry hinted on this, where job growth is a little bit slower in Colorado than it had been in other parts of the country. A lot of that due to just some of the headwinds that were a little bit more exposed to tech and some of the headwinds that were there. You certainly saw that spillover. But we also saw a little bit slowing migration of workers to Colorado, somewhat new to us. And that was a little bit of a headwind to overall job growth. So a bit of a different scenario. My big takeaway is that, yes, the job gains have been particularly strong, but are we seeing demand, private sector demand, really start to slow down? And I think so far we're seeing some early signs of that. Okay? Have we seen consumers really slow down yet? A little bit, but from high levels. We're starting to see some headwinds. Anecdotally, we're hearing that actually consumption is starting to slow down. It's hard to see because hotels are still, charging pretty high rates. When you go and travel around, vacancies are still staying where they were, not pre-pandemic, but that's from different issues. They've seen some tightness. But what we're hearing is some of that travel has shifted away from, it used to be Thursday to Saturday, Thursday to Sunday, and now it's Monday through Thursday. It's more business travel. So again, we're seeing a shift away from this leisure hospitality. Taylor's not on tour anymore. Beyonce's not on tour anymore, okay? The Chiefs, from Kansas City. The Chiefs won the Super Bowl. Nuggets had their win, right? We had the draft was out there. All that really supported actually a real consumption. And what we're hearing is that consumers are not necessarily doing that anymore. And so it's a retreat from these exuberant levels. So it's something to be seen as, yes, there's a retreat from those exuberant levels of consumption. I want to try to understand, is that a headwind? Henry reported that actually houses aren't more in debt encumbered than they were prior to the pandemic. Kind of returned to a normal level. So there are houses, many, many households that are stressed, but we aren't necessarily seeing signs of distress. To be fair, I think about this differently. Often the case is there's a smaller number of households that are able to support their spending through cycles. I maybe don't think about it as how much people are going, but how many people are exposed to stress. A great indicator that's put out by the Federal Reserve System comes from the SHED survey. Maybe a better question is to ask how many households could manage a $500 surprise expense without having to borrow? That's a good indicator of stress. It has risen over the last couple of years as we recover from the pandemic and as those economic stimulus payments rose. Anxiously anticipating the update to that because you want to see how much stress is out there among households. So, okay. I'm going to close with maybe a couple of risks and highlight that we did not time this, but 24 minutes ago, we just released a new data, a product from the Kansas City Fed that is the Commercial Real Estate Index. I think we want to do a better job of tracking that community here within the Federal Reserve Bank of Kansas City's region. There's a number of reasons that you want to understand the connections of commercial real estate broadly. I mean, the commercial real estate space is your retail space. It's your office space, right? It's your factories. It's your manufacturing capabilities. You really get a broad lens by looking at commercial real estate with a wide part of our business activity in our communities. So you definitely want to understand it. But also, you understand it because community banks, smaller banks, and to a large extent, regional banks, actually have a much larger footprint on their loan books dedicated to commercial real estate. I'm maybe talking to the audience that this is something you know. So for the community banks that are around our region, they're much more exposed to some of the risks around commercial real estate. And absolutely, we have seen a decline, in fact, a further decline over the last couple of months in overall commercial real estate activity. A way to read this is 0 means historical norm, and we're talking about like standard deviations away from this. We're at very low levels of overall activity. What's interesting is that when the first decline in commercial real estate over the last 18 months was really driven by the financials. It was rising interest rates. It was headwinds about the uncertainty about the vol that was sitting out in interest rates. It was a real headwind to transaction activity. It was a real headwind to pricing. It was a lot of difficulty getting deals done. While those challenges still persist, what we heard over the last quarter, the update that came out today, was that actually now it's not so much the financials. There's been some stabilization over the last few months, but it's that leases are coming up, spaces are becoming more available. They aren't being released. When they're not released in certain properties, you actually see that means everybody else, many of the other tenants, I'm thinking maybe shopping mall is a good way to think about this, is when an anchor tenant goes, other participants in that mall are allowed to renegotiate their lease, which means the incomes on those properties are changing. It was that decreased utilization, that decreased absorption over the last couple of weeks and the last couple of months that's really been driving the level of this index down. This is important for us to track. I'm not showing it here, but if you were to plot on this for Colorado, or in the same way if you were to plot it for just the region, the ebbs and flows in construction employment, when this declines about 4 quarters later, we tend to see declines in overall construction employment. So we haven't seen it show up yet. In Colorado we have, but nationally we haven't seen it show up yet. But this would pretend that maybe there's some headwinds to construction coming online, construction employment coming online. So yes, there's some signs of slowing demand. And it's such an important thing to think about is to shift the focus away from the supply shocks, the labor supply, the supply chain bottlenecks, the productivity. Shift away from that because there's big reasons to think those shocks aren't going to be repeated. Start looking at demand, and we are seeing some early signs that consumer spending is maybe starting to slow a little bit. Hiring is starting to slow a bit, but we are seeing risks in the commercial real estate sector, and we're seeing those risks be fairly widespread across asset classes. But if we talk to contacts in the region, we're seeing that market segments are telling us very different stories about the path of commercial real estate. So how do you understand this high level of disagreement that's out there that when an asset could be performing very, very well and 3 miles away in a central business district, it's not? And so we're going to see lots of disagreement out there that we want to try to understand going forward. But I will pause there. I'm happy to take any questions. I don't know if you wanted to moderate this. That's all right. Good. Thank you all.
Why don't you guys have a chair, and we've got so many great questions. I've been sitting there taking notes on all of them. But I think you can tell that Nick Sly is one of the smarter guys in the room. The information that he has and trying to keep up with all that data is amazing. And we do have the ability to get that report that you talked about coming out today. Is there any suggestion how they can get that?
Yeah, it should be posted on our website now.
So if you go to the website, I think especially those of you in commercial real estate, you would find that of great value. Before I jump into the Q&A, We want to remind everybody that there will be a feedback survey of our event that will be sent to your inbox later this morning. We'd really appreciate it if you'd take a minute and provide us some feedback on the event and questions and comments and data that you'd like to see in the coming years as we do this. I think it would be really helpful. So let me jump right into the questions, and there's a lot of really good ones. Some of our real estate developers have talked about, because of this 500 basis point increase in rates, that it has really slowed, if not stopped, real estate development in the state of Colorado and in the economy. What they're also telling us, though, is that projects still don't work financially unless rates really come down 200, 250 basis points. And so what does that mean, and how does that play through the economy?
I'm happy to talk about it. I think this is an important thing to talk about as we're seeing a couple of developments. One of them is it's not just the level of interest rates, but this was one of the, it was in fact the most rapid increase in rates in decades. And so it wasn't just the level of rates it went to, it was the volatility around that. At the next FOMC meeting, each of the participants, each of the Reserve Bank presidents and the folks in Washington, they're going to submit a projection of what they think the appropriate level of rates will be over the coming years, so something to pay attention to. But even though we're in 2024, so you're making a projection for the year that we're in, and these are the folks that are actually setting that policy. If you look at the range, the dot plot, which is the charts that we love to look at, there's still about a 250 basis point range in what is the projected level of, the projected appropriate level of interest rates that's sitting out there. And that is to say, there is a question about how high rates had to go. There's a question about where they might retrace to. And there's still an awful lot of uncertainty around that. And that volatility and uncertainty is another factor that's inhibiting folks from sitting and writing a deal out that'll actually make it pencil. And so I think you need to see a couple of things before you see the construction activity, development activity stabilize. It's not just stabilization, the level of rates, but it's some clarity on that path of rates as it's going forward and seeing that volatility really start to slow down. But can't say where that's going to be. I'm interested in where you guys might be projecting it's going to be. But it's a couple ways that we're trying to have that conversation.
Henry?
Thank you. Yeah, it's a complicated subject. I think one thing in Central Business District of Denver is the age of the different buildings. And I think it's almost building by building and debt service building by building. I think most businesses have realized 100% remote work doesn't sustain your culture or your vibrancy of getting work done and interpersonal skills. A lot of the success, I think, from that work from home during the pandemic was the pre-existing relationships carried forward into the Zoom room. But that's getting to be a long time ago now, and people may have moved on. You might have a bigger team. You have different problems. You don't keep as much connections, or not the cup of coffee, the side chat. But how do you run an office when people are only there half the time? So I just think we're in a period of churn and working it out. Also, optimistically, if the mechanical and the engineering side of it for repurposing some of the Central Business District buildings into housing, that could create some repurposing of assets. Again, I think it's going to be building dependent, and I think we're just in one phase of it now, a very acute aftermath of the Great Recession. But there was just an interesting article. There's a hedge fund guy swooping in and buying distressed real estate in San Francisco now. So that might be a great bet. He might end up flat on his face, So there you go, two-handed economists.
Got to have some courage, though, if you're going to invest wisely going forward. On a sort of related basis, back during the great financial crisis in 2008, we saw a bunch of problems in real estate, but we saw a correlation to other industries that struggled as well. So if we're not seeing a lot of new real estate development, what is the potential impact on contractors and suppliers and other parts of that real estate food chain? Are we concerned that we're going to see some disruption there as well? And many of those folks are in this room. Any advice for either of them?
Yeah, I think this is a conversation that needs to be had because there's data that doesn't elucidate really that connection. Commercial real estate deals, you guys know this better than I do, it takes multiple years to get something developed, and once it's actually penciled out and its funding is secured, that work kind of stays and keeps going. What that means from an optics standpoint or a monitoring standpoint is that we're in a situation where the slowdown of architects and actually making drawings The actual slowdown of land development appraisals that actually takes place out there doesn't really show up in the data for 4 to 8 quarters, 1 to 2 years, which doesn't mean that it doesn't impact those households. And so you have to be cognizant of trying to track, yes, slow down in the development of land, slow down in the development of some of these projects absolutely does hit construction employment and does have some spillovers to the broader part of the economy. The concern that I have is that you might be missing it, because it's very easy to look and say, well, things are still ongoing, but that was stuff that was penciled in a year or two ago. And we say that monetary policy from the Federal Reserve acts with long and variable lags. Part of the reason for that is that you know that it's the policy decisions and the level of interest rates when those deals were set that mattered. What we really need to do is be looking forward. And so the best thing we do is track, yes, there's real impacts for real estate, from real estate to construction employment. There's real impacts for our transportation infrastructure. And we need to be cognizant of when they're going to be realized, maybe 4 to 8 quarters out from now.
That's well said. And I think when I said your mileage may vary, as you're talking about all these nice headline statistics, say things are going well to a commercial or residential real estate broker. It's like, sorry, man, I hope things will turn around. And so I think it's one part interest rates coming back down to get that virtuous cycle going again. I think also the demand for housing has shifted. The aging population is affecting demand for housing in certain places. When we look ahead and that baby boomers turning 80, a couple years after that, if past is prologue, there might be some housing availability that starts to manifest over a longer time frame. Now, that does nothing for someone's business or their household budget, but the supply of housing, if you play it out for a longer period, might start to change just from people passing on. It's an awkward subject, but the dismal science. I think right now what people can do is what are the holistic policy interventions that could stimulate growth? What's in the way that we can get out of the way, and let as much market forces come back and be part of the decision making.
Good answer. I think everybody appreciate that. Let me switch gears here. Some of the questions I'm getting texted to me as I'm standing here. You both spoke about income levels across the state, and there's this income and wealth disparity issue, which is so critical to all of us, and how do we address that? Can you both speak to sort of your take on that issue, and can something be done to change that, and what are the ramifications to us societally if we don't do that? That's a big one.
No, it's something that I think we want to have a better vocabulary for, because it really does matter, right? If you're in a situation where every household, or maybe say every business, gets hit and has to trim 2% from their budget, that is a very different scenario than if you have 50, 60% of your businesses who have to make serious cuts and other businesses are able to grow. And there's the vernacular that does not work really well when you start talking to folks is that economists use is the intensive margin versus the extensive margin. I actually don't want to ask as much about the intensive when I think about how much wealth gap is actually out there, or you think about how big of a difference there is in the ability to make these payments. I want to know how extensive it is that households may not be able to make a $500 surprise payment, because that's going to tell you how vulnerable a overall economy will be when there is an adverse economic shock that comes out there. And so there has to be a way for us to talk with our communities to understand, hey, are there support systems? Do you have a reserve? Are there protections in place for that? And it's just a different conversation about how extensive is the stress or are the challenges versus, on average, how much are we able to absorb them. And so I always think it's an important part of the conversation to think whether it's wealth inequality, whether it's job security. Some folks are systematically employed in jobs that are much more cyclical and more exposed to job losses. Whether it's household budget constraints, do they have the flexibility to actually absorb that? So it does need to be something, in my opinion, that we talk about regularly and that we understand not just how big some of these costs or these shocks might be, but how much of our population, how much of our business community is actually exposed or able to weather them. So that tends to be how I think about it. We got to be more creative with our questions.
Very complicated subject. We could have a whole lunch just on this one thing. And I think what strikes me about this issue is that the word interdependence is not a word people love as Americans. We want to be independent. But when you look at how the machine works, there is an interdependence between private sector, philanthropy, and government. And so to round it out for households and businesses and safety net, the connection between those three dots needs to be nominally stable. And so I don't think you can fix that whole slide that I showed with a policy intervention. But there are availabilities that can improve that situation. So how do people improve their wealth? They get educated, they have access to wealth building tools, and there are supports and safety nets if things go wrong. So I think a reinvigoration of the conversation of where are the connections strong in that interdependent model and where are they weak, that might mean sitting in a room together and disagreeing and finding paths forward, because I don't think you can only push one button. But I do think changing the relationship, it's almost like Nick says, the language. If we can change our relationship to the word interdependence, maybe that chart could look a little different, and it's a rising tide for more people.
And just relative to that wealth creation, so many people talk about it in the context of being able to invest in home ownership or other things like that. Relative to the policy opportunities, what are the 2 or 3 things that maybe that interdependence could focus on? Is it being able to afford a home to create wealth and investment, or what other buttons can we push to try to address that?
So I'm conflicted on the home ownership idea. Some days owning a home is great, and other days the furnace breaks and it's all on you at once. So congratulations. And in those days, it's kind of like the renters should be giggling at you. It's like, I'm only paying my share of the furnace that I used while I was here. So this home ownership thing is kind of tied into the mythical American dream. And I'm not sure ownership is the only way forward for all households. Obviously, it can be an amazing wealth building tool. So I don't want to say that it's not, but access for the people who want a home might be the policy to pursue, as opposed to, I think I know what's best for you. I'm completely biased because of my personal experience and where I work now, but the power of education and the power of human capital investment, I mean, the data is irrefutable. Of more education accrues to more life and financial benefits for people, and it allows them to pursue their path, as opposed to having some big office where we're going to kind of manage workforce and manage the economy from a conference room. Thank God it doesn't work that way, because it can't. And when places try to do it, it doesn't work. So leverage the power that each person has within them, and let that kind of flourish. Those are the top 2 things kind of on my mind.
Nick?
Yeah, I was thinking about when we talk about wealth building, and there's several avenues that are often talked about separately. Again, to use my intensive and extensive margin language, one of the best predictors of lifetime earnings and lifetime wealth is actually not the job you have. Education certainly can matter, but it's not your occupation or the type of firm that you're in. It's the number of years that you worked. And so that is a better predictor and a larger driver of disparities in wealth and in income between white and black workers, between white and Hispanic workers, across generations. It's how many years did you work? And so the conversation being is, how do you build wealth? It's creating attachment to the labor force, and fluidity in that space is very meaningful. And that's not a policy statement. It is something that's cultural. How do you manage through some of those ebb and flows? It just becomes, how natural are we at having that conversation? I think it's very important. That's something else that I look to.
So another series of questions that we've had come in relate to the national debt. And there seems to be so much concern of out of control spending at the national level, the level of the national debt. You showed debt levels relative to GDP. How concerned should we be for that relative to the future of Social Security, other kind of federal programs? And what insights could you give us there? I know that's also a big question, but your questions today are really smart, so thank you.
Well, so we could talk about the debt as a number, or we could talk about it as a symptom of how our decisions get made. Reconciling revenues and expenditures is something all of us do every day for our houses and for our businesses. So the economist kind of training tells us, some amount of federal debt is necessary and beneficial. It also spreads costs around. It helps us manage downturns. And it's a tool that we want in our toolkit. I think we're kind of, obviously you could see from the chart, we haven't been at this number before many times. The last time, I think, it was over 100 was World War II for a brief period, and then it came crashing down when the war was over, troops came home, GI Bill, and then the American machine just took off. So that chart is a symptom of our politics. It's also a symptom of our demography. A big driver there is aging population and Medicare expenses. Expansion of Medicaid is also part of that. So we have some unfunded long-term liabilities for things that I think most people are expecting on their own behalf. Social Security should work on its own because it's a payroll tax. So unless we don't have anybody working, there should be revenue into that system. Over the years, the federal government has tried to figure out, well, should we just not only just keep it as a cash account? Could we use it more like a pension and manage that? Very complicated conversation to have the government investing in the stock market. It's something that doesn't sound American, but boy, would it help that machine work a little bit better. So, you know, those are the drivers. So what do we want and how are we going to pay for it? That's where we're at. I don't know that any economist knows what the magic number of GDP needs to be.
I will say on that, I'm really influenced by the work by my colleagues, and I think about, you know, lifetime earnings issues, or I think about even fiscal debt issues. There's a great group of people at the Federal Reserve Bank of Kansas City who are working on this, and particularly with regard to public debt, I try to think about it less as a number of when you get to that it becomes unsustainable, which I feel is the conversation that we have, and the way the question is framed. As opposed to the way that most all of us think, which is probably is the risk profile that's associated with that, is that higher debt burden is going to increase the risk every time there's a downturn. Every time that grows a little bit bigger, every time the federal debt gets a little bit larger, you actually are increasing the risk that a downturn will be more severe, okay? It also works the other way in that it actually shrinks some of the risk. In April, May, June of 2020, we had 22 million Americans that were unemployed and not sure about the future of the business that was actually out there. And the ability of the Treasury to issue debt wasn't there. The financial markets were broken, and so you needed an intervention to actually get it even functioning again. And what we have done is somewhat, you can use the phrase kick the can down the road, or you can use the euphemism of spread the risk out over time or over the population. Let's get away from the euphemisms. What we did is we took the biggest shock in terms of employment or in terms of economic activity that we'd seen in a century. And instead of dealing with it at a time when 22 million people were unemployed and financial markets were not working, we spread it out over the future. And now we're there. And it is something that, you know, we are going to have our own decision of whether or not it would have been easier to deal with at that point in time versus kind of spreading it out over now. That's a decision that we have to make as a society. But I just see it as it worked both ways, where we spread the risk of that event that was the pandemic early out over time. And then we actually have the question is, okay, how do you rein it back in to limit the amount of risk so the next time that there's a shock or a downturn, it doesn't become a financial crisis, it's a normal ebb and flow business cycle. So I tend to think of it as risk. There's no one number that's risky and it's not. It's the risk grows as the debt burden grows. It's certainly more challenging as interest rates are up. And then I'll say something else that I'm paying attention to is getting out of the sort of limits of policy and how much can be implemented, is understanding that it's hard to look back and take real signals. Over the last couple of decades, we're in a period where the federal government was issuing debt, and the buyers of that debt were Saudi Arabia, they were Russia, they were China, they were Southeast Asia, there were some places in South America that were buying that debt, and with more of those buyers of it, it meant that the interest rates could remain somewhat low. Now we're in a situation where those countries that are in adversarial relationships or tense relationships are not buyers or holders of that debt anymore. And you have to think about who's actually going to be able to buy that up or actually issue the debt to the government. It's harder. It means that debt service has to go up. So we are in a fundamentally different scenario now as we manage through this risk spreading scenario than we have been over the last couple of decades. And I want to be careful not to look too back and take the wrong lessons from a time that doesn't apply, because it is different today.
You want anything to that?
No,
you're looking at me like you do.
That was really good. I hope that got recorded.
It did get recorded, by the way, and we can make sure we get that to you. So here's an interesting question. With all the spotlight this past year on banks across the country and financial strength and bank failures, I know the Fed is a regulator of banks. Can you give us some insight into what you see as potential risks within the banking system? It was a liquidity risk issue before, back in March. Now there's some concern over commercial real estate and charge-offs relative to the commercial real estate world. Any insights into that from the Fed's perspective, and then Henry, from your perspective as an economist?
Yeah, I have to add one more disclaimer to my front one. I'm not a regulator. I said there's a nice firewall between us, so I won't speak to any of the regs that are coming out there. But I do see that attention is it is looking at two different issues. You need to be careful to make sure you're attentive to both. There was the liquidity challenge that came up over the last year, for sure. The Federal Reserve is about to sunset a program that put in place to make sure that the community banking, regional banking, the global banking system had liquidity. It's called the Bank Term Funding Program. It'll sunset in March. And then there's a lot of focus on making sure that banks have access to liquidity if there are ever any of those shocks that were there. And so you're making sure that there's some resiliency for funding levels. At the same time, you have to look ahead, not just head down to those issues, but look ahead to what are the coming risks that are out there. I think there's a lot of questions about how exposed are individual banks and their holdings. We know the community banks are much more concentrated in their commercial real estate risks. So we're looking at what are those concentration levels, and then you start to ask, when does that become an institutional issue, become unserviceable for those? And then when does it become a systemic issue that actually you could have a credit quality issue at some banks, spill over into other financial institutions. One way to track that is to ask the question repeatedly. There's a way to do this with the regulatory environment, and there's a way to do it that's, I think, a bit more open to the public. And it's important to share that public version of that is, how severe do bankers or lenders see that deterioration of credit quality in their CRE loan portfolios? How would they characterize it? And I will say so far that both in realized and in expectations, the overwhelming majority of them is saying that the deterioration in credit quality has been mild or modest, as opposed to something more moderate or severe. So something to pay attention to, but a lot of focus on it for a number of different ways.
Yeah, I should be clear on this next point. I have no idea how to answer this question. I think, just from a couple anecdotes, the only thing I would add to the discussion is that we've seen some major banking disruptions the last couple of years. The big one in California failed. I forget the name right now. Silicon Valley, yeah. But since then, not a lot of headline news about this. And some of the bankers I've talked to, while they might not be lending because mortgage rates are expensive, they've been able to very safely earn 5 or 6% of the money they have on deposit. So I think there's a lot of money available to borrow. But for the other headwinds that we've been talking about, people aren't able to go down and say, I can make this work if you loan me the money. So there may be just some quiet days at many banks right now. But again, I don't have a comprehensive scan to share with the group, sorry.
So as a banker, I feel obligated to answer this question as well. And I do think it's important because since March 9th of last year, this has been a major topic for everyone. Everybody wants to understand, do I need to worry about this? How do I evaluate this? And so many of us have spent a ton of time really trying to present to our clients and our prospects, how do you judge if a bank is safe? We go through and we show them our liquidity and how much we have in the way of deposits to fund our loans. We go through and we look at credit quality. We look at the duration of our investments to make sure there isn't interest rate risk. And we meet with our clients all the time. And if your bank isn't doing that for you today, I would go ask them. Be students of the economy, be students of the banking industry. And most of us who are public companies, as our company is, publish this data on a quarterly basis. And we're proactively sharing it with our clients. So there doesn't need to be a risk. And I agree with Nick that generally the liquidity problems that came into the market of last year were unique to a couple of banks who had very niched kinds of businesses. They were concentrated in a few industries like technology, which is what happened to Silicon Valley. And they put their investments long term, and they couldn't get cash when they needed it. That problem has generally been solved, I think, across the industry. The second major risk, as he said, is really about credit quality. And I think if you look at credit quality across the country, while it's softened some because of the real estate issues, it's really very solid across the industry. And we would all be very happy to give you tutorials on reading bank financial statements if you would like to do that. I've been hosting this for over 20 years, and I've never asked a political question. because there is no right or wrong answer. This is a quasi-political question, but several people asked it. And it is that Congress is so polarized today. Does it really matter who wins the election? Do you have any comment? I know you can't answer it in any kind of a reasonable way, but it's sort of a softball question I think we need to ask. So any comments on just how we address this polarism out there in the political world, and will it make a difference on economic policy? I told you couldn't answer it, but I had to ask.
This reminds me of that scene in Caddyshack where the preacher goes, "There is no God." Does it, does it really matter? Sure, yes, it matters. So, yeah.
I think that sort of sums it up, doesn't it? That's really good, Henry. That's the best answer of the day. Anything you want to top that with, Nick?
That's in there. No, the Federal Reserve stands ready to pursue its missions regardless of
I knew I'd get a rise out of you on that one. Okay, we got time for one more question. This is also a little bit of a softball question, but I think it's on everybody's mind. And that is, how do we look at and prepare for AI, what it'll mean for our businesses, what it'll mean for the workforce? There's been a lot of discussion about certain categories of workers being totally displaced as a function of AI. There's security risk around AI. From both of your perspectives, how would you address the issue of AI and its future impact on the economy?
Yeah, I think there's a policy intervention that could happen around automation of work. And I think we should probably embrace automation of work. We have an aging population. We have an incoherent immigration policy for this country. And so demand for workers, is might be exceeding the supply of workers if you play it out. So I always thought the intervention could be that you find a way to tax the use of automated technologies, and that would be one of the available supports that you have, similar to workers' comp or unemployment insurance. The state has this office now for when legacy industries go away in the energy space. They call it the Office of Just Transition. It's an awkward phrasing, but the idea of people being displaced having a path forward of some kind, that's easier said than done, but I think structurally, if we levied a fee of some kind on the use of automation, because it is a profit-making endeavor at some level, and used it to that idea of retraining, transition period, we could find our way forward, because I don't think the technology is going to slow down. Innovation is kind of hardwired into our brains and into our economy. And we also know that it works best when there's a human and a machine. The symbiotic path of that seems to work out the best. So that's my take. No one will go for it, but that's my thought.
So at the risk of making the most banal comment that you can, I'll state the obvious. AI is here. And that seems like it's a very obvious statement, but I think it's an important one to make outside. Businesses are making real hiring decisions based on their expectations or the reality of their ability to implement AI in their businesses, meaning it is already being disruptive. And I think that's something we do want to highlight. It's not far off. It's something. It's a past tense. It's here. It's something to be implemented. And I think we're seeing a range of early adopters and late adopters, first mover advantage, second mover advantage. So it is something that actually is disrupting economic outcomes in a real way. We see that anecdotally. We're starting to see a little bit in the data. How I suspect it's going to go, don't often want to make prognostications, but like many other technologies that are out there, we'll overshoot in our ability to adopt it, and then we'll rein it back in and we'll find the best set of applications from it, just like you do with any new technology that's out there. And so I suspect that we're going to find some really great ways to use it. We're going to find some ways that we probably shouldn't be using it or that aren't that productive. But the market's going to work that out necessarily, and it's going to take a little bit of time. But to your point, the partnership that has to happen between someone who understands what goes into the model and what comes out is similar to what we just did today. Was you can put data out there, but what's the inference that you draw from the data? What's the lesson that you learn from the data requires some analytical thinking and requires some experience working in a market. The same, I think, is going to be true with this technology. It's a shovel, it's a computer, it's an automated machine. It's going to be how adept we are at using it is really going to drive how productive it is for the U.S. economy. But I think a lot of the conversations have been alarmist or risk or out there or put it off as something that's future. The reality is that we're hearing anecdotally when we survey businesses, it's changing hiring decisions, it's changing resource allocations today. And so we're going to have to continue to monitor how firms are using it and how they're not or they are getting out over their skis.
Great answer, and maybe a nice way to finish up with those commentaries that the whole concept of this event is to take that kind of data, the important economic information that we need, but then find a way to translate it into activities, whether that be how you vote, whether that be policy issues at the state or the federal level, that all of us as informed citizens can make such a difference if we can listen to guys like this who make such a difference. So please help me thank our speakers today, and what a great job they did.
What a pleasure, man. Nice to meet you.
And thank you again to all of you and all of you who are online. We so appreciate your rapt attention. It's important for all of us to be students of the economy and to continue this debate going forward. Vectra Bank is committed to that. Both CSU and the Federal Reserve are committed to that. And we look forward to working with you in the years ahead. And here's to best wishes for a successful and happy 2024. Thank you all for being here.